Welcome to this Killick Explains video, and the backdrop to this one is rising volatility. Now I'll give you some evidence for that in a moment as if you needed it, but I'm going to be basically saying we're in a volatile market, that's pretty clear. So I'm going to give you 4 principles, if you like, to stick by as an investor as we get through this volatile phase. It won't last forever, but it does seem to be reasonably well embedded as I make this video in early summer 2022. So evidence for rising volatility is everywhere really. The VIX, the fear gauge, is up well above its long-term average and seems to be staying there at the moment. Stocks are bouncing around all over the place. They've dropped quite heavily recently, 2 or 3 times, triggering those 10% letters that you may have received because regulators require investment managers and so on to send them out. Technology stocks have been particularly hard, reflected in the performance of some of the funds that specialise in that area. Cryptocurrencies, risk assets, if you like, have taken a complete battering. You've got changing bond yields as people rush to safety and seek safe havens. So it's all kind of going on. Now, why is this happening? What should you be doing about it? Well, the reasons are many and varied. Inflationary fears are a big one. At the time this video is being made, UK inflation had hit around 9%, depending on which measure you use, well above the Bank of England's 2% target. You've got rising interest rates, how far and how fast, yet to be decided. You've got evidence of slowing growth around different parts of the economy, key indicators and so on, falling consumer confidence, and lower spending and investment trickling through from businesses as confidence starts to ebb away a little bit. So what does this mean for investors? And I think what this slightly unpromising backdrop, which won't last forever, means is you need to focus on 4 things. And I'll run through them now. 1, don't panic. Always remind you of that one. 2, stick to your plan. 3, look for opportunities to top up holdings where shares may have taken too much of a battering by the market, and focus on cash. And it's that last point I want to pay a bit of more attention to, the normal cash measures if you're looking at companies that I think are fairly robust and are relevant right now. So going back, number 1, don't panic. Thanks for that, Tim, but why not? Well, actually, although those 10% drop letters, if you've been receiving them, or emails, may seem to be coming with more regularity than they have in the past, the reality is if you look back over, say, UK stock market history, you get a 10% drop, roughly on average every year, a 20% drop roughly every 5, and a 30% drop every 10. So large corrections are in fact not as rare as some people might think they are. And therefore, that's useful to know, because the market does tend to go on eventually to recover and go on to greater and better things. All right, so bear in mind that the best periods often follow the worst. So the darkest days are often just ahead of the light, if you like to use a cliche. Often the stock market will dip sharply before bouncing fairly sharply. So don't try and do anything clever in market timing terms. My usual advice, stay diversified. What is becoming clear is that, for example, there is a bit of a trade-off going on in the market between defensive and cyclical stocks, value and growth, and within growth, different types of growth stocks. So diversify, and if you're feeling nervous, hold a little bit more cash. But don't go mad, and certainly don't liquidate into cash, because my point number 2 after don't panic is stick to your plan. Now, I've mentioned this several times before, so I'll keep it brief here. The 3 pots approach makes an allowance for rainy day funds. Yes, maybe if you're in charge of a family, up to 6 to 12 months worth of cash spending on the sidelines. Foreseeable calls on capital, that's where you keep money relatively safe for expenditure that you know is coming up and you're going to have to fund reasonably soon. And then the rest of your funds should be invested somewhere where they stand a chance of beating what is now quite a heady inflation rate. And that's only really possible in certain places, equities being a good bet. All right, so don't allow market conditions at the moment to put you off that 3 pots approach, that methodical approach to measuring out how much cash you need versus where you're going to actually earn decent long-term returns. That's number 2. Number 3, look for opportunities. Bear markets tend to mark everything down together. You get irrational exuberance, as Alan Greenspan once called it, on the way up, and irrational depression on the way down. So be a little bit patient, all right? Be a little bit confident and make sure you've got some cash on hand to take advantage of the fact that some of your favourite long-term stocks may get overly marked down as the market gets over pessimistic. So there are opportunities when stock markets are in this kind of volatile phase. It's not all bad news by any means. And then finally, in terms of choosing stocks, in terms of what you look for, if you're looking for robust opportunities within the stock market, I would say cash has to be king right now. So I want to just remind you of a few core cash measures, a few ways of looking at stocks, rolling your sleeves up, if you like, and getting under the bonnet. So watch cash flow per share. That's annual cash flow over the number of shares in issue. All right. Watch cash flow yield. In other words, take a look at how much cash is being generated by the business per share as a proportion of the share price. All right. Look at the conversion ratio. To what extent can the business convert operating profits into operating cash flow? Is there a stable relationship there? And if not, why not? Look at interest cover from a cash flow point of view. In other words, what cash is available to meet interest charges on debt, which may well be rising right now, okay? And do look at it from a cash flow perspective. Dividend cover, again, I'd urge you to think about doing it from a cash flow perspective. What is the amount of free cash flow, as it's often called, available to meet the annual dividend? That gives you, as an income investor, some reassurance that the dividend is sustainable. And finally, little safety measure, don't forget about the quick and cash ratios. That's the relationship between, if you're looking at a quick ratio, receivables and cash over short-term liabilities. Can be done with stock in there to give you current assets over current liabilities, but I prefer the quick version, which takes out stock. And then there's the cash ratio, the pure cash ratio, which is just cash over current liabilities. And all of those measures together build a picture as to whether the business you might be about to invest in, figuring that it's good value, it's a good entry point if you like, is in fact fairly robust and can weather what could be quite a choppy period over the short term. Now, if you'd like to know more about any of the things I've just talked about, do access my video library. That's killick.com/learn. And if you'd like to receive a copy of any of the guides, there are two here. There is another one with a different colour cover. It's a blue cover called How to Invest in Equities. Then it's editor@killick.com. Sorry, it's editor@killick.com. And if you'd like a copy of this magazine, Confidant, which puts some of this stuff into context, then again, editor@killick.com.